Thank you. 5 sessions to go, including today. So, the nagging will build to a crescendo sometime this week. So expect to get 2 emails every day saying, are you done yet? Are you getting there? No. But as I said, I'm going to drag you over the finish line one way or the other. You have no options left. It's too late to get out. Okay? But you're closer than you think. It's not that you're far away in terms of what you need to do. It just looks intimidating. So this Thursday, I'm going to send you a to-do list. Hopefully, most of the things on the to-do list are already done. But if they're not, at least you know what remains to be done. So today I want to continue with our discussion of dividends. We talked about how taxes were weighed against dividends for a lot of the 20th century and how things have converged. But even though the tax rates on dividends and capital gains remain the same, there is still that tax disadvantage of dividends, which comes from what? Why would you rather receive capital gains than dividends? Because you decide when to pay taxes. That timing option could be worth a lot. It might not be worth much to you. So today I want to start off by looking at why companies pay dividends, starting with some bad reasons for paying dividends. And then we'll talk about good reasons. And then we'll talk about a way of assessing whether your company pays the right amount in dividends and perhaps expand it to include buybacks. So here's one bad reason for paying dividends. And I've heard companies give this. They argue that investors look at dividends as more certain than capital gains. It's called a bird in the hand fallacy, which is if you receive dividends, you get that check in the mail, capital gains are uncertain, you don't know whether you'll get them. And that sounds reasonable, right? Dividends are in fact cash in your hand. But here's the comparison that really should be made. Remember what happens on the ex-dividend day? You pay a $2 dividend, roughly speaking, what happens to your stock price? It drops by $2. So the real comparison is not between dividends today and price appreciation in the future or capital gains in the future. It's dividends today versus capital gains today. Would you rather have a $50 stock and no dividends, or would you rather have a $2 dividend and a $48 stock, which makes the comparison much more even? So if you as a company are paying dividends because you think investors are going to reward you with a higher stock price because they value dividends more highly, I would suggest you rethink that, because that doesn't seem to happen. Investors don't reward companies just for paying bigger dividends. There's a group of investors who might like your stock, and we'll talk about this later. You'll acquire a clientele, but you've got to be careful who you attract, because those investors will now demand more of what they want. So that's the first reason companies give for paying dividends. Here's the second one. We had a good year. We have lots of cash flows this year. We don't have very much in investments this year, so why shouldn't we return it to stockholders, either in the form of dividends or buybacks? Well, again, sounds good, and especially if you go down the dividend path, here's what you got to worry about. You had a good year this year. Unless you can tell me that this is a permanent process, that you're going to continue to have good years and excess cash flows in the future, what's the danger of giving the cash back this year? Next year you might need cash to take investments, or have a bad year, in which case what do you have to do? You have to go out and raise capital. You're saying, what's the big deal? Raising capital is not free. There's an issuance cost. And that issuance cost can actually be very high, especially if you're raising equity, which is what you'll have to raise if you pay too much in dividends. Now, the good news is, as the issuance gets larger, the amount that you have to pay gets smaller. But there is still an issuance cost, and that issuance cost is much greater with issuing equity than issuing bonds. So if you have too much cash flows this year and you give the cash back and you have to go back to markets and raise equity, that sounds incredibly short-sighted to me. In fact, if I get a chance, I'm going to show you the percent of companies globally that pay dividends and issue stock in the same year. Sounds absurd. But even worse, there are companies that buy back stock and issue stock in the same year. I don't even know how to explain that phenomenon. But you have companies that seem to, out of one window, give out cash, and the other window raise cash. The only people who are happy about this are who? Your bankers. This is amazing for your bankers that you do this, but it makes absolutely no corporate finance sense. So don't pay out dividends because you expect to get a premium in your price. Don't pay out dividends because you had a good year. So you're saying, why should I pay dividends? There are three potentially good reasons, two noble reasons and one ignoble reason. So let's go through the potentially good noble reasons first. The first is there are some investors out there who seem to like dividends. And you could probably help me out. If you looked across investors and you categorize them, what types of investors like dividends? Sam? One is large, not all large, but some large institutional investors. If you're a pension fund, for instance, you like dividends. Why? Because you don't face a tax penalty anyway. And if you have cash flow needs that you got to pay out, dividends are great as a way of getting those cash flows without having to sell stock. So one could be tax-exempt institutional investors. Among individual investors, what types of investors might like dividends? Retirees. Older, poorer investors often prefer dividends to younger investors who might not need the income. Any investor who needs income is more likely. So there's an argument that if you have investors who like dividends and you can pay more dividends, you could potentially get a clientele that matches what you pay. So if you're a company that pays no dividends, guess who you'll attract? Investors who don't like dividends. If you pay small dividends, you'll attract investors who like small dividends. If you pay really, really big dividends, guess who you'll attract? Dividend addicts. And you got to be careful who you attract, because those, what's the essence of an addict? Is they're never quite satisfied. So you attract dividend addicts, what will they want next year? More dividends and still more dividends. You can't cut them off because they're addicted to dividends. So you got to be careful who you attract, because those investors are going to be around for a while. So that I'm going to start with that clientele and give you evidence that there are enough investors in each grouping that if you choose to go with a certain dividend policy, you will attract investors in that dividend clientele. The second argument I'm going to make is sometimes dividends can operate as a signal. I'm always a little leery of signaling arguments in finance because you can tell any story you want. So I'm going to tell you one story about how higher dividends can be a positive signal about the future. But then I'm going to ask you whether it is possible that in some companies an increase in dividends could be a negative signal about the future. And you're going to see that the signaling story can cut both ways and which one ends up dominating. And there's a third argument, and this one is a little dicey. Remember, there are two players in this game, equity investors and lenders. If lenders were allowed to set dividend policy at companies, how much would they allow companies to pay out as dividends? You don't want the companies to pay out no dividends. Why? Because if they don't pay out dividends, what happens? Cash accumulates in the company. And remember, that means your interest payments and principal payments are much more secured. So if a banker set dividend policy for companies, the lenders, you'd basically say don't pay dividends. Now, if you flip it around, you're an equity investor in the same company. Do you see what could happen? By paying dividends, what are you effectively doing? You could effectively make lenders worse off, and to the extent that you can exploit constraints and pay out too much in dividends, you might transfer wealth from lenders to yourself. You're essentially expropriating from bondholders. Now, bondholders should know this, and lenders should know this, and usually what do? They set in covenants. You cannot pay out more than X% of your earnings as dividends. You have to maintain a certain cash balance. But if you forget to do that, then in a sense you're asking to be taken to the cleaners, and you usually are. So let's take the clientele story first. There's actually a very simple test of the clientele story. And this test was actually run about probably 45 years ago on a bunch of Canadian utilities. And these Canadian utilities had a very strange stock setup. They had two classes of common shares. On Class A shares, you got a cash dividend. So this half of the class can be Class A shares. So you get a cash dividend, $2 per share. Class B shares, you get a stock dividend. Normally stock dividends are completely useless. You know why? Because if everybody gets a stock dividend, nobody gets a stock dividend. What happens to the stock dividend? You own 100 shares, what do I give you? 2 extra shares. You're saying this is good. But if everybody gets 2% more shares, what happens? Well, the number of shares increases by 2%. So when companies pay stock dividends, it's one of those useless transactions. But in this case, Class B shares get stock dividends, and you can convert into Class A shares anytime you want. See what effectively I've given you? I've given you a choice between would you rather have a dividend or would you rather have a capital gain? The same amount. Now remember, this was the 1970s when the tax law was clearly against dividends. You're taxed at 40, 50% on dividends and at 20% on capital gains. So this half the class got a cash dividend, this part of the class got a capital gain of equal amount. Which class of shares would you expect to trade at a higher price given how the tax law is written? I would expect the investors who get the capital appreciation, the Class B shares, to trade at a premium over the Class A shares because you get a capital gain and they get a cash dividend. What this study found, they could not explain. In every single one of these companies, the cash dividend shares traded at a premium over the stock dividend shares. It's almost as if in these companies, investors would rather receive cash dividends than capital gains. And the paper tried all kinds of contortions to try to explain it. But I think the simplest explanation is there's a selection bias here, which is if you pay these cash dividends, the investors who buy these shares like the cash dividends so much they're willing to pay a premium. So by itself, if you told me I'm going to pay a cash dividend, I'm not going to use tax law to beat you up, because there are enough investors out there who like these cash dividends that you can get away with paying the cash dividend. That's what's right. So don't do it just because of the premium. Do it because it's right for you, and there'll be investors out there who buy these shares. And if you look at what kinds of investors buy these high cash dividend shares, and there are several studies that look at this, here's what you find. No surprises. Older investors, poorer investors tend to buy shares, if you look at individual investors, tend to buy shares in companies with big cash dividends. Among institutional investors, pension funds are more likely to buy your shares than mutual funds. There is this selection process where once you announce your dividend policy, you attract investors who like that dividend policy. That's called the clientele effect. It's just a fancy name for you will attract investors who like your dividend policy. In fact, there was one study that looked across all U.S. stocks and tried to explain differences in dividend yield across stocks. And this was in the good old days when companies just paid dividends. There were no buybacks. Today, this study would be much more difficult to do with just dividends. And here's what they found. Riskier stocks pay lower dividends than safer stocks. So I'm actually giving you a template for trying to explain why your company, remember the company in your project, might be paying no or low dividends. If your stock is in a riskier business, I would expect to pay lower dividends. Firms with older investors pay higher dividends than firms with younger investors. Firms with wealthier investors pay lower dividends. And finally, the tax rate clearly played a role because they looked across time at the difference between dividends and capital gains taxes, and they found that the bigger the tax penalty associated with dividends, the lower the dividend yield on the company. So if you're trying to explain differences in dividend yield across time and countries, one of the phenomena that explains is what kind of investors buy your shares. But now I'm going to pose the prompt to you. I said you attract the investors that your dividend policy tends to be, they like it. If you pay no dividends, you get investors who like no dividends. If you pay large dividends, you get investors who like large dividends. But think about a scenario where you've historically paid a lot in dividends. Why? Because you are a regulated utility. Phone companies, remember, used to be regulated utilities. They were monopolies. They had stable income. They tended to pay among the highest dividends of any group of companies in the U.S. And this was the 1970s or 80s. So they were in this policy of paying 70, 80% of their earnings as dividends. Then the world shifted under them. It shifted under them because you got wireless and you got technology. They essentially became more technology companies than regulated utilities. So you're the CEO of a phone company. You now realize the business has shifted, that you're now a technology company. You need to reinvest more. You have this dividend policy that was set in the old days. And it's not working for you. Do you see why it's not working for you? If you pay 80% of your earnings as dividends, you can't reinvest what you need to. So I'm going to ask you a question of what you as a CEO of this company would do, given that you now have a dividend policy that doesn't meet your needs. So here are your choices. You could go in front of your shareholders and courageously announce that you're going to cut dividends, what's going to happen to you? You'll be lucky to get out of that meeting alive. Remember, these are dividend addicts. Trying to tell an addict, I'm cutting off your supply, is not a good idea. Nothing good happens to top managers at companies when they announce. So you'd like to do it, but odds are you're going to find that you get a lot of pushback. The second is you can continue to pay the dividends. This is the denial strategy. Pay the dividends you always did and put off investing till a future date. That future date will never come because you're never going to have the cash. You can do that. The third is you can continue to pay the dividends you used to and issue new stock to cover your reinvestment. Well, maybe this explains those companies that do both. You continue to pay the dividends because you don't want to tell those people you're paying too much and you issue stock. In fact, telecom companies in the US did all three, depending on the company. And there was a fourth strategy that some of these companies adopted, which is a creative one. What's creating the problem here? You have this old phone company that people are used to buying stock in and getting dividends. You now have a new business that requires a lot more reinvestment. So what do you think some companies did? They essentially created a second business for just the technology part. Verizon Wireless. Telecom Italia Wireless. They created that section and they said the people who buy shares in this, in fact what they did was actually offered to their existing shareholders a choice. Do you want shares in the old company or the new company? And if they were clever enough, they at the outset announced to stockholders, those of you buying shares in the second company will be buying shares in a technology company. There will be no dividends, but there will be a lot of growth. And they let investors self-select. And guess what? That's what Bell Labs did. I mean, that's what AT&T did with Bell Labs. Bell Labs was part of AT&T. It was their technology arm. They decided keeping it part of AT&T would not work because they could not give it the same corporate finance policy as the rest of the company. They created Lucent, which was a great initial idea. They screwed it up completely afterwards. But essentially the objective here was to create a second company which had a different dividend policy, a different financing policy, and a different investment policy than the first one. Increasingly, as you see disruption coming to mature businesses, this is a question a lot of companies are going to have to answer. Should JP Morgan have a fintech arm within the company, or should they make JP Morgan fintech into a separate business? Should Volkswagen, the electric cars, be a separate business? It's a question they all have to examine because these new businesses they're entering into are very different from the old ones, and the investors in the old companies might not quite get the requirements of these new businesses. So if you have a dividend clientele, great. But if you have to change your dividend policy then, remember you now have to deal with the fact that your clientele will have to change as well, and that doesn't happen overnight. In fact, when Apple first announced its first dividend, which wasn't that long ago, it was about 7 years ago, one of the questions I raised was, do you really want to do this? Because you're going to now attract investors who like dividends, and if you don't think this is the way you want to return cash, why open the door? If your response is, they have a lot of cash to return, there's an alternative, right? Where you can buy back stock and keep your old dividend clientele. And increasingly, I think that's what's happening at these tech companies that have a lot of cash. In fact, if I get a chance, I'm going to show you buybacks by sector. And you know by far where the biggest stock buybacks are happening? They're not in manufacturing firms, they're in technology firms. Technology firms are the biggest buyers back by whatever it is, of their own stock. And one reason for that is their investor bases don't want dividends. So that might also explain why you see the surge of buybacks as the aging cash cows of this decade are the technology companies, the Intels, the Apples, the Microsofts, and you're seeing that cash go out in the form of buybacks. So that's the first reason. You have a clientele, you nurture it. Here's the second. There's a story you can tell about dividends as a signal. You know what signaling is, right? I'm looking around to see if anybody's wearing a suit. If anybody's wearing a suit, why are they wearing a suit? Because they have an interview. Why do you wear a suit to an interview? Because it's a signal. that you're willing to be uncomfortable and sweat in the middle of summer and have a tie choke you because you really want this job. It's a signal. I don't know how good a signal it is because, maybe a $3,000 suit is a better signal than but we constantly look at things for signals. And dividends, in a sense, might be a signal of what? What's the word that I used to describe dividends? They're sticky, right? So when you start paying dividends, what have you agreed to do? Continue to pay them. So here's the positive signaling story about dividends. That if you raise dividends, it must mean what? That you feel so confident about future earnings that you're willing to commit to paying these dividends. The commitment created by dividends is what makes it a positive signal. That's why buybacks can never be the same signal. Because with buybacks, you pay the money today, you might not do it in the future, but the very fact that you're committing to pay dividends might be a signal that you feel confident about future earnings. And there is some evidence, at least in the overall market, that dividends do operate as signals. And here's how it comes about. Remember that we talked about the ex-dividend day. On the ex-dividend day, you know exactly what the dividend is going to be. But about 6 weeks before the ex-dividend day, the board of directors got together and declared a dividend. And when they declare a dividend, you can either increase dividends, do nothing to dividends, or decrease dividends. And we looked at the overall numbers. You notice that most companies did nothing to dividends. But among the companies that changed dividends, 3 to 4 times as many companies increased dividends as decreased dividends. So these studies in finance that look at dividend changes tend to focus on the dividend declaration date because that's the date on which they announce the change in dividends. And they look at dividend increases versus dividend decreases. Let me take the dividend increases first. So this is the announcement day, and these studies look at what happens to the stock price on the dividend announcement day. So there's the AD is the announcement day, and in the announcement day, the stock price jumps. Shows you how researchers play with graph setups. It looks like a huge jump, right? The only thing is I've changed the axis. So it was about a 1% jump, but because I made it go from 0 to 1%, it looks like a big jump. Statistically significant, but there is a positive jump when companies announce an increase in dividends of about 1%. When you look at dividend cuts, which are far less frequent, when you now look at the announcement date, there is about a 4.6% drop in stock prices on the announcement day. Let me pause right there. So when companies announce increases in dividends, their stock price goes up about 1%. When they announce a cut in dividends, their stock price drops about 5%. How do you explain that asymmetry in reaction, Sam?
Is it that the magnitude of the price increase is just small, the price decreases, or the dividend?
But why is that? Why would a dividend cut be more bad news than a dividend increase is good news? In fact, just before I set this up, what did I say about dividend cuts and increases?
That they'll change policy and there's going to be pushback.
I gave away the game. How many more dividend cuts than increases than cuts did I say there were? 5 times as many companies increased dividends. It's a very simple magnitude effect, right? If far fewer companies cut dividends, your reaction is something must be really wrong at this company for it to cut dividends. So what you're seeing here is the flip side of the fact that dividend increases are far more frequent than dividend cuts. And my suggestion is the next few days, just look at the Wall Street Journal for announcements of dividend changes. And if you see a cut in dividends, check the stock price, and almost invariably you're going to see a much bigger negative price impact on a dividend cut than you see a jump in the stock prices on a dividend increase. So generally speaking, there is this backing for the argument that dividends are positive signals. But let me ask you a question. For a company, let's say you have a company that announces an increase in dividends. Can you conceive of a story where you see a company increase dividends and your reaction is, oh, that's awful news about the company? Or what types of companies would you look at a dividend increase and see it as bad news? I'm sorry? One is levered companies because they're being insane. So if Tesla announces a dividend increase, it'll be completely in line with the rest of the insanity of the company. Say, there, finally, why don't you just do a buyback as well? Dig a deeper hole for yourself and bury yourself in it. So one is highly levered companies. Where else? But highly mature companies, you want to increase dividends. Actually flip that around. If you say a mature company increase dividends, it makes complete sense, right? But think in terms of the life cycle. What type of company, when you see an increase in dividends, you're going to say, really? If you have a really high growth company with, you thought the company had incredible investment projects and it announces an increase in dividends, what's your reaction? They must not have the kind of investments I thought they did. Maybe I'm overestimating growth, in which case I'm going to bring down my growth rate. You could actually have a scenario where a dividend initiation or a dividend increase is followed by a stock price decrease. That's why I'm leery of signaling stories, because you can very quickly flip the story around. In fact, there is some very weak evidence I can offer that when you see dividends being initiated at a company, it's usually a signal that your best days are behind you. So what this study looks at is the earnings growth by quarter leading into the quarter in which dividends are initiated. So you see that just as earnings growth peak, what does a company do? It announces we're starting dividends. If you look at the quarters after, the growth rate is, it's not that the dividend initiation is what's lowering the growth rate. The company knows that its projects are starting to get less, they're not as good as they used to be, and it initiates dividends. So dividends in general tend to be a positive signal, but you can visualize a scenario that an increase in dividends could actually be a negative signal. But here's something else that's interesting that seems to have changed over time. Those studies that looked at dividend increases and decreases, there have been studies done in the 80s, the 90s, the last decade, leading into this decade. And what these studies find is that the effect of dividend changes in general have started to get smaller for both increases and decreases. That 30 years ago, when a company cut dividends, the stock price dropped 5%. Today, the companies cut dividends, the stock price drops only 2%. Companies increased dividends 30 years ago, stock prices went up 1%. Today, they're going up 0.4%. How do you explain that? Why are dividends less signally, if I can create that word, than they used to be? That one could be that they could return, but so one could be the shift to buybacks, and you're not getting the same signal. So that's one. What else? As investors, do we have access to more information than we used to? When a company's in trouble, 40 years ago, if you're not a professional investor, you probably didn't even know they were in trouble until they announced they were cutting dividends. Today, you're surrounded by news stories. So when you see dividend changes, the amount of news that's in a dividend announcement today might be far less than it was 40 years ago. And my guess is you're going to start to see this play out in emerging markets as well. As information disclosure gets better, as you get more information, dividends are operating as less as signals than they used to be because you have so many other sources of information. So dividends can attract clientele. They can be a signal. One final rationale, and this is not a good one, but it happens anyway. Remember, we saw what happens to stock prices when dividends are increased. They tend to increase by about 1%. This study actually looked at something interesting. Looked at bonds in the same company around a dividend change. And it discovered the exact opposite effect. When companies increase dividends, stockholders, for the most part, celebrate, so the stock price goes up. But bondholders, actually, it's not good news. You see bond prices tend to drift down. So if you're a company with a lot of debt, one reason you might see buybacks is you're just ripping off your bondholders. It's not a noble reason, but it's saying, you left me an opening, I'm going to take advantage of it. So when you look at why companies pay dividends, these three factors can explain much of what you see happening out there. So let's bring this all together. We looked at lots of reasons why companies increase dividends, decrease dividends, do nothing to dividends. So let's close with what CFOs claim to look at when they set dividend policy. So this is from a survey of CFOs where they were asked, well, when you look at dividends, what are some of the things that weigh into your decision? So I'm going to read off from top to bottom statements that were read to CFOs, and then there were CFOs asked, do you agree with the statement, disagree, or don't know? So keep your eye on the no opinion. These are CFOs who have no idea what the answer to the question is. That's kind of scary, right? So first is a firm's dividend payout ratio affects the price of the stock. 61% agree. It's kind of a very badly worded question, right? Affects the price positively or negatively, but the 61% think that their dividend payout ratio affects the price. 6% disagree, 33% have no idea. Dividend payments provide a signal. 52% agree, 41% have no opinion, 7% disagree. The market uses dividend announcements as information for assessing firm value. 51% have no opinion. So basically, they have 41, 43, but among the ones that had, 43% agree, 6% don't. Investors have, so that's a clientele story. 56% agree, 42% have no opinion. Investors are basically indifferent. 6%, only 6% agree with that statement, 64% disagree. And this was done in the 90s, so in those days the tax difference was very, very visible. Stockholders are attracted to firms with dividend policies appropriate for that tax stockholder. 44% agree, 49% don't. Now, none of this is proof of anything. It just means that for the most part, CFOs are all over the place when it comes to dividend policy. And this is perhaps the reason why Me Tooism and inertia becomes the driving force for dividends. Is unlike other aspects of corporate finance where you can be clean about your judgments, dividend policy people are all over the place. So if you ask most companies, are you paying out the right amount in dividends? Or giving it back in buybacks? The answer is we don't know. Yes?
Is it safe to assume that the stock will recover from the dividend decrease?
No. How can it, right? Because the question was, is it safe to assume that the stock will recover from the dividend decrease? Why did the stock drop? Because the firm that think of a firm that's worth $1 billion. It has let's make the dividend really big, $100 million dividend, right? There are 100 shares in the stock. So right now, $1 billion divided by 100 is $10 per share. Let's say this company pays a $100 million dividend. What happens to the value of the company? Cash leaves the company. The company's value is going to go from $1 billion to $900 million. Your stock price is going to drop at 9. It's going to stay at 9. Why? Because you have $1 of cash in your pocket. So you're not worse off when the stock price drops, because what I've given you is instead of a $10 stock, you have a $9 stock plus a $1 of dividend. So this is not an information effect if you think about. So, but if there is the announcement effect when dividends are cut, stock prices drop. Whether stock prices recover or not there is more debatable. Under what conditions will they recover? So you have a dividend cut and people react and they push the stock price down. Well, if you can show that that dividend cut was accompanied by something good, right? You say, I cut dividends to take good projects. You might not get an immediate reaction because everybody lies. But if you can actually show that you're investing more in your projects, then the stock price will recover. So dividend cut accompanied by other stuff. And that's always the advice I give to companies. If you're cutting dividends for the right reasons, you're that telecom company with great projects. Initially, you're going to get punished because they're going to tar you with the same brush as everybody else cutting dividends. But if you can show that you're bundling this dividend cut with other decisions, then there's a greater chance of your stock price recovering. So let's talk about how to decide how much cash a company should return and in what form. So to make this, I'm going to give you 2 different ways of assessing dividend policy. We looked at lots of different ways of assessing optimal financing mix. We'll talk about only 2 for assessing dividend policy. The first is what I call my cash trust nexus. I describe dividends as more than any other aspect of corporate finance as being driven by trust. Do you trust management of the company? So we're going to go through a way of assessing dividends by looking at how much we trust managers in a company, how much they can return, and how much they actually did return. Okay? And the second approach is very similar to how most companies set dividends. They look at everybody else in the sector and they say, if they're paying a lot in dividends, I'm going to pay a lot in dividends, the peer group approach. So let's start with the cash trust nexus. And there are 3 basic questions I'm going to try to answer with my companies, and hopefully you can answer with yours. First is, how much did the company actually return? That should be the easiest of the questions, because I look at dividends and I look at stock buybacks, and I look at the cash returned over time. Second, I'm going to ask, how much could my company have returned? Sounds like a difficult question, but it's actually one of the most straightforward questions in corporate finance to answer. How much cash was left over? after I met every conceivable need. So in the second question, I'm asking, what is the potential dividend? What could I have paid out? So when I'm done asking the first two questions, I know what you actually paid out. I can also estimate what you could have paid out. What are the three possibilities? You paid out exactly what you could have. You paid out less, in which case you're accumulating cash, or you paid out more, in which case you're drawing down cash or borrowing more money. In the third question, I'm going to ask you, how much do I trust the management of this company? And to answer that question, I'm not going to ask managers, can I trust you? That's a stupid question because they're going to say yes. I'm going to look at your history of taking projects. Have you taken good projects? And second, how well have you done for me as an investor in terms of stock returns? Now do you see in terms of sequencing why you do dividend policy last? Because to be able to make that judgment, I had to go through that Jensen's alpha when I did my cost of capital. I had to go through the excess returns I computed by looking at a return on capital versus cost of capital. So by the time I get to this stage, I'm ready to answer those questions based on your history. And the way I treat you as a company will be very different if I don't trust you as managers, as opposed to, there's a reason why Google can accumulate $100 billion in cash and nobody whispers anything about it. They let it go. And there's a reason why HP can't get to $1 billion in cash without investors jumping down the back saying, give me the cash back. You earn the right to accumulate cash, but you earn it. You're not entitled to it. Any CFO complains that he can't accumulate cash is missing the point. You don't get the right to accumulate cash. It's not your cash. If you want to hold my cash, I need to trust you. And I'm going to base my trust on whatever you've done for me as a stockholder. So let's start with the question of how much companies have returned to their stockholders. So I'm going to take my 5 companies and assess how much they return. And with each company, I'm going to look at both dividends and buybacks. 25 years ago when I used to see corporate finance, I just used to look at dividends and ignore the buybacks. I can't afford to do that anymore because 2/3 of cash is returned in the form of buybacks. So let's start with Disney. Between 2008 and 2012, the company returned about $4.5 billion in the aggregate in dividends. Not bad, but they returned almost $15.4 billion in the form of buybacks. So they returned almost 75%, or a little more than 75% of their $19.8 billion in cash that they returned came in the form of buybacks. If you look at Vale, about $24 billion in dividends. That is a huge drain on the cash flows. And this is a period where iron ore prices were down and their earnings were dropping. And we're going to talk about why Vale got trapped into this dividend policy. And it's a problem that a lot of Brazilian firms share. And it goes back to what we talked about in corporate governance. They issued 2 classes of shares. Now they're being bound by those 2 classes of shares. Okay? And if you look at but on top of that, they also bought $5.7 billion in stock buybacks. Tata Motors returned almost 51.4 billion rupees in dividends, very tiny buybacks. So buybacks were not a big phenomenon for them. Baidu, 0, 0, 0, 0, 0. So basically no dividends, no buybacks. And finally, Deutsche returned about $4.4 billion in buybacks, and even that 4.4 billion was 4.4 billion dollars too much, 4.4 billion euros too much. And I'm going to back this up. So let's start by looking at what what these companies could have afforded to return to their shareholders. I'm going to devise or concoct a measure called free cash flow equity. Okay? So when I first started thinking about dividend policy, it was actually when I was doing valuation, I said, I don't like dividends because in the dividend discount model, we're focusing on what companies actually return. And I said, how do I know whether that amount is the right amount, too high or too low? I'd like a measure of how much a company can afford to return. So I'll give you the intuition from which I started. Let's suppose you're the owner of a company. You're the equity investor, the only equity investor in the company. And you're looking at how much cash is going to be left in the till at the end of the year after you've met every conceivable need. Let's build up to it. You start with your measure of earnings, which as an equity investor is what? Net income. But then you remember that depreciation is not a cash expense, so you add back depreciation. So think of that as your cash available from your operations. So that's your starting point. And then you're going to start writing checks. Think old-fashioned. You're writing checks. The first check you write out is to CapEx. So if you do any capital expenditures, that's cash leaving the firm. So it's a cash outflow. If your working capital increase, that's another cash outflow. So you subtract those out. And if you have debt payments due, that's another cash flow as well. What you're left with at the end of that process is called your free cash flow equity. You're saying, why is new debt issued in here as a cash flow? When you borrow money, remember cash comes from the firm. So some of your cash payments, debt repayments, so think of that as a net cash from debt. So if you look at the bottom lines, free cash flow equity, if you look at those line items, which statement, which accounting statement am I going to get those line items? Every one of those should be in your statement of cash flows. In fact, if you look at the breakdown of the statement of cash flows, the first grouping is cash flows from operations, right? But the accounting definition of cash flow from operations is net income plus depreciation minus change in working capital. So that's the cash flow from operations. Next grouping is investing cash flows. Be very careful because they throw things in like investing in financial assets in there. But if there's CapEx and investment back into plant and equipment, it's going to be there. And if you go to the third grouping of cash flows, it says financing cash flows. And in there, you're going to see debt repayments and debt taken on. So everything you need is in the statement of cash flows. And if you can use that statement of cash flows, which you should be able to for almost any company around the world, you can get a measure of the free cash flow equity. So let me ask you a question. Is it possible to have positive net income and negative free cash flow equity? Absolutely, right? What kinds of companies is that going to be happening? High growth companies, and here's why. Because your CapEx is going to be much higher than your depreciation. Because usually people say, well, if I have high CapEx, what my free cash flow equity? Most companies which have high CapEx also have high depreciation. So you need your CapEx to be much larger than depreciation. That's going to happen as you're growing. So if you have a high growth company, you can have positive net income and negative free cash flow equity. Let's make dividend policy really simple. If your company has had negative free cash flow equity for the last 5 years, every year, how much dividend can it afford to pay out? Don't think too long. The answer is obvious. It shouldn't be paying dividends. So if your company pays dividends and has negative free cash flow equity, you have a dividend problem. A dividend problem in the sense this company is paying out dividends it cannot afford to. It's not the end of the analysis, but that first step suggests there's a mismatch, and you have to explain that mismatch. If you have positive free cash flow equity, that is what your company could have paid out to shareholders, either as dividends or buybacks. So if you have positive free cash flow equity, I'm going to look at what you actually paid out. And where would I find that in your accounting statements? Still in the statement of cash flows. Everything you need for dividend policy is in the statement of cash flows. Because your dividends will be there, your stock buybacks will be there. And when I add those two numbers up, I might have that odd company that pays out what it can afford to. I might have a company that pays out more or pays out less. I'll show you the statistics for what that comparison yields across the world. But you can see that it can cut in any of those three directions. So that's a full computation of free cash flow equity. I'm going to give you two other versions of the free cash flow equity that kind of simplify the process. One is to take depreciation, CapEx, and change in working capital and consolidate them into one number called the reinvestment. I like this in valuation because it takes these three line items that are often dealt with as three separate line items and says, look, the net effect of these three line items is it tells me how much I'm putting back into the business. So CapEx minus depreciation, called net CapEx, is what I'm putting into my long-term assets. The change in working capital is what I'm putting in my short-term assets. So reinvestment is just another word for CapEx minus depreciation plus change in working capital. And I can take debt repaid and net debt issued and call that net cash flow from debt. I'm just redefining terms, but it's good to think about in both terms. You take net income, you subtract out the reinvestment, you add on the net cash flow from debt, you have free cash flow equity. And here's an even simpler version. If I tell you that a fixed proportion of my reinvestment always comes from debt, I said 20% of my reinvestment always comes from debt, I can take the net income, take the net reinvestment I had from the previous section, and look at the portion of that that comes from equity, in this case 80%, and come up with free cash flow equity. But that third approach can be used if and only if I have a constant debt ratio that I use on my reinvestment. I'm measuring the same thing, but three different ways of getting there. And the first two are just variations in terms of how I call things. So let's look at that third version, right? Free cash flow to equity in the simplified word. It's net income minus net capex times 1 minus the debt ratio. That's a portion of my long-term investment that's coming from equity, minus the change in working capital times 1 minus the debt ratio. It's the portion of my working capital that's coming from equity. I come up with free cash flow to equity. And again, this can be used only if you have a stable debt ratio, 20%, 30%, 50%. You might even pick your optimal debt ratio, because by the time you got to this section, you know what the optimal debt ratio for your company is. You can compute the free cash flow to equity. And that's going to be the fulcrum that's going to determine for you whether your company is paying out too much, too little, or just the right amount. So let's compute Disney's free cash flow to equity. Every year, remember for the 5 years I showed you where Disney returned $19.8 billion? Let's see what they could have returned. That sounds like a lot of cash to return. So to compute the free cash flow to equity every year, here's what I did. I started with the net income, subtracted out net capex and change in working capital. That's a reinvestment. Net cash flow from debt is debt repaid minus, and my free cash flow to equity over the 5 years was $27.1 billion. But a lot of that came from the fact that Disney borrowed a lot of money over these 5 years. And that's a little, you don't want to build a dividend policy, cash return policy based on just going back to the market and borrowing more. So I looked at what the free cash flow to equity would have been before the debt cash flow, and the free cash flow to equity that I've had just from operations would have been about $18 billion. So if they'd done nothing to debt ratios, left them unchanged, they'd have had about $18 billion to return to shareholders. That's what they could have returned. They actually returned $19.8 billion. Let me pause right there, because this is something you're going to run into on your project. If free cash flow to $18 billion, they returned $19.8 billion. Am I ready to pass judgment on Disney as doing a bad thing? What else do I need to consider? What did we find when we did optimal capital structure on Disney? The optimal debt ratio was 40. They were at 12%. They had a lot of excess debt capacity. Do you see how the two tie together? If you are under-levered, what should you be doing? You should be returning more than your free cash flow to equity, because you want to increase the debt ratio. So what I'm saying is, don't look at dividend policy in isolation. In fact, don't look at any aspect of corporate finance in isolation. Before you pass judgment that your company is returning too much in cash, go back and look at your capital structure, because that might explain what your company should be doing. In this case, I can see Disney is returning more than its than it could, but I'm also able to see that it has excess debt capacity. And my conclusion is, hey guys, you are doing the right thing. In fact, you might want to increase even more cash, because you're not moving fast enough towards the optimal debt ratio. Now, just to give you a sense of what happens when companies start to accumulate a lot of cash. All this fuss you're hearing about Apple having a lot of cash, a lot of people don't remember this, but 20 years ago we were having the same debate about Microsoft accumulating a lot of cash, because Microsoft was the demon of that age, right? A company that was going to become so big and so powerful that was unstoppable. Keep that in mind when you hear people talking about Google and Apple being unstoppable. There are other companies that have been viewed as unstoppable. Microsoft had a second coming back party, but this was their first go-around. Using Office and Windows as the cash engines driving them, Microsoft had huge cash flows every year. In fact, this was in 1996. Their net income was about $2,176 million. CapEx was $494 million. Depreciation was $480 million. So if I pause right there and ask you how much Microsoft reinvested in 96. 494 minus 480 is 14 million. That doesn't sound like a lot of reinvestment, right? But what am I missing when I say Microsoft did not reinvest very much money? Their R&D was treated as an expense. The net income is after their big capex. So, but their net income is already after R&D. If I subtract out the 14 million and the 35 million working capital change, I get a free cash flow to equity of 2,127 million. So the bottom line is, in 1996, Microsoft could have returned $2.1 billion to its stockholders. It paid no dividends and bought back no stock in 1996. So it returned no cash. So I have a very simple mechanical question. They could have returned $2.1 billion, They chose to return nothing. Where on Microsoft's balance sheet would I find this 2.1 billion? I heard somebody say cash. Why couldn't it be going into projects? Because I've already counted in your R&D and CapEx, so it can't be going to projects. I'm glad nobody said retained earnings, because that's the wrong side of the balance sheet. There is no other place for this to go than as an addition to a cash balance. So in 96, the cash balance increased by 2.1 billion. In 97, they had a $3 billion free cash flow equity. They returned nothing. So you add another $3 billion. In 98, they had a $5 billion free cash flow equity. You're saying, why? Go back and look at every Windows update, because that's how they used to make their cash flows, is every time they upgraded Windows, they got a huge cash surge. 5 billion, they returned nothing. The cash. So you can see 2 plus 3 plus 5, and that's not even counting the interest income you make on the cash. By the time you get to 2002, Microsoft had 50 billion in cash. In those days, that was the largest cash balance that any company had. Now the point I'm making here is when you see companies with large cash balances, whether it's Apple with 250 billion, Google with 100 billion, or any other company, managers claim to be surprised at these companies. I don't know how this happened. I can tell you exactly how it happened. It wasn't manna from heaven that showed up in your balance sheet. It was a direct reflection of the fact that year after year you chose to hold back some cash. In the case of Apple, they've been trying. God, have they been trying? $350 billion in cash returned over the last 5 years. But they aren't trying hard enough. Their cash balance has still increased. But the way companies end up with big cash balances is if year after year your free cash flow equity. So you can take any company with a large cash balance and you estimate their free cash flow equity and cash returned over time. You'll see the accumulation of the cash over time. In some companies, it's not a problem. People let them have the cash. I gave you the example of Google. In some companies, that accumulation of cash is going to trigger a blowback. And we're going to look at why that happens in some companies, because it sounds so unfair. You're leaving Google alone with 100 billion. Why are you picking on me with a $3 billion cash balance? And we'll see there's actually, it's fairly easy to explain once you look at the insides of these companies. Now in the case of Deutsche, trying to compute this free cash flow equity using the traditional approach is going to be really difficult. Think of why. I can start with the net income for a bank, but if I think about capex and depreciation and working capital, it's going to be impossible to do. So I'm going to do what I did when I did capital structure. I'm going to come up with free cash flow equity in a very different way. I'm going to argue that for a bank, your reinvestment is not in capex and depreciation and working capital. It's what you have to invest in regulatory capital. What's going to drive that investment in regulatory capital? It's going to be driven partly by growth. If you're a high growth bank, you will have to increase your regulatory capital more to keep growing. And the second is if you're an undercapitalized bank, you need to reinvest more in regulatory capital just get back to steady state. Deutsche is not a high growth bank, thank God for that. But it was an undercapitalized bank and was losing money. If you take those factors in and you build up over time, their free cash flow equity is actually negative, negative, negative for the next 3 years, which effectively means that if you were Deutsche and say, how much dividend should I pay? My answer is very simple. You can't afford to pay dividends. And this has been true for Deutsche since 2009. But for the first half, from 2009 through 2014, they continued to pay dividends. Banks are among the worst culprits on sticky dividends. I remember talking to bank CEOs in 2009 and 2010 when banks were pretty much basket cases when it came to regulatory capital, and these banks continued to pay these big dividends. You ask them, why are you continuing to pay dividends? You know what their answer was? Because we don't want to send a negative signal. What universe are you guys on? Every day I open up the newspaper, I see 100 news stories about you that send me all the negative signals I want. If you're continuing to pay dividends, it tells me you're in denial, not that you're facing up to these problems. But it's very difficult for managers to make that step of saying, hey, and many of these banks, because they've been paying dividends there have been banks that have been paying dividends for 110 years in a row. And they get trapped into this dividend policy because they make that their ad. We've paid dividends 110 years in a row. The minute you say that, you're in trouble because next year, if your regulatory capital falls, you can't afford not to pay the dividends because you put out this boast. So banks get trapped into dividends they can't sustain. Yes?
Free cash flow to equity is just for a period, but they might have accumulated cash balance historically from the free cash.
So that's one of the other things you're going to keep. That's why you never do a single year, because free cash flow to equity in any given year can be positive, negative, or zero. So with your companies, I'd suggest, with Disney, I went back at least 5 years. You can go back 10 years. You can see the cash accumulation. And you also have to look at the optimal capital structure. You've got to bring both in, right? Because otherwise you might pass the wrong judgment on the company. If I just looked at just 1 year for Disney and said, hey, you guys are paying too much in dividends, I'm passing the wrong judgment because I'm failing to factor in cash buildup in earlier years, and I'm also failing to factor in that they have excess debt capacity. So look at both cash buildup and debt capacity when you pass judgment, but you need to start by looking at this assessment of how much could they have paid out, how much do they actually pay out. Okay? So let's see how the world looks in terms of dividends and free cash flow to equity. So you compute dividends, you compute free cash flows to equity. When I said dividends, I include buybacks as well. Right? So I'm going to take the entire world and break up companies into 5 groups. And as I go through, remember, your company has to fall into one of these 5 groups. They include every conceivable possibility. The first is companies which have free cash flows to equity which are less than 0 and are returning no cash. These companies are doing the sensible thing. That's why I've left them in black. 63% of companies in Australia, New Zealand, and Canada fall in that grouping. You know why? What kinds of companies dominate Australian and Canadian markets? A lot of natural resource companies, and it's been a particularly bad period for natural resource companies. So at least they're doing the right thing, which is not paying dividends. They're in free cash flow to equity. The second grouping are companies that have positive free cash flow to equity but return less than that free cash flow to equity. So basically, their free cash flow to equity is greater than 0, but they're returning cash, but they're returning less. So these are cash accumulators. Okay? 12% of Australia and New Zealand. But if you look at adding up those two groupings, I would think of as doing the right thing. Companies with negative free cash flow to equity that don't pay dividends, companies with positive free cash flow to equity that are paying less than dividends. Of course, I'm keeping capital structure out of the mix. So you can see the breakdown around the world. And about 47% of companies globally are doing the sensible thing when it comes to dividends, which is actually not a great number because that means 53% of companies globally are doing things that cannot be explained purely looking at free cash flow to equity. This is a single year, so that's a downside. I'm looking at 2018. But here's the breakdown of the 3 groups of companies that are tough to explain standing alone without bringing in cash balances or excess debt capacity. The first are companies which have positive free cash flow to equity and are returning cash but are returning more than that free cash flow to equity. So they have dividends and buybacks, and those exceed the free cash flow to equity. The second are companies with negative free cash flow to equity that are continuing to pay dividends and buy back stock. And the third is companies with negative free cash flow to equity where those two look the same. So I'll have to check. One of these has to be different because they can't be the same. But whatever the 3 red groupings are the groupings which are tough to explain. You add those up, 53% of companies globally have dividend policies that if you look at just last year's potential dividends are tough to explain. So when you look at your free cash flows to equity, think of that as what your company could have paid out. If it's negative and the company is returning any cash, look for reasons. Maybe last year was just a bad year. Maybe this was just, so look at the average over time. If that can't explain it, look at excess debt capacity. Maybe they're trying to give them every benefit of the doubt. But at the end of the process, you say, look, I can't explain this. Then you have an unsustainable dividend policy. So dividend policy is not complicated because the numbers are all right there in the statement of cash flows. It gets messy when you have to change it because you've got investors who are used to what you're doing, and now you've got to tell them, we're not going to do what we've always done. Okay? But that is at the basis for assessing dividend policy. Any questions on this assessment? So let's talk about companies that do get into trouble by accumulating cash. I gave you the example of Microsoft, right? 96, accumulating a lot of cash, 97, 98, 99, 2000, 2001. Cash balance keeps building up. And the same can be said for many of the technology companies of today, especially the older ones. They're in their mature phase, and they're throwing off cash like it's nobody's business. Apple is a classic example, just cash machines. And they're accumulating cash. For the most part, they're left alone. But there are other companies out there that accumulate cash that essentially get into trouble. So I'm going to go back in time to 1994 and look at Chrysler. At that time, 3 automobile companies, GM, Ford, and Chrysler. Chrysler was the smallest of the 3 automobile companies. And for those of you who remember the story of Chrysler, Chrysler almost went bankrupt in the early 1980s. It got a tiny bailout, small by today's standards, and it got a new CEO called Lee Iacocca, who brought it back to life. You know what brought it back to life? Every time I go into a shopping mall, I curse Lee Iacocca. Because what did he create that now populates our roads? He created the original minivan. Right? Basically, that's what rescued Chrysler, is the original minivan. And that brought Chrysler back to life. So this is the post-recovery phase where Chrysler is building itself back to health. So each year, here's what I did. I computed the free cash flow equity, that's the white bar. I computed what they returned to stockholders, that's the black bar. I took the difference and I put in, so in a sense I was trying to explain how the cash balance ended up at $8.5 billion by the time you get to 94. And you can see it building up over time. So as you go from 85, 86, 87, they hold back cash, and by the time you get to the end of 94, they had an $8.5 billion cash balance. That sounds like nothing, right? Like penny change. And compared to the cash balance of today, it was nothing. But in 1994, Chrysler's market cap as a company, enterprise value as a company, was about $30 billion. $8.5 billion in cash in a $30 billion company means 30% of the company is cash. And people noticed. And one person in particular decided to make an issue of it, a guy called Kirk Kerkorian. Right? That time he was in, is he still alive? But he lived into his 90s or something, right? This was when he was a sprightly 82 or something. He decides that this is a problem, that Chrysler has too much cash. And he decides to take a position in Chrysler and make an issue of the cash. So he bought about 5% of the shares. He called a press conference and he announced, you have too much cash. That was pretty much the entire, too much cash, you need to give the cash back. What do you think Chrysler's pushback was? We're a cyclical company, bad things can happen to us, therefore we need the cash. Which is almost laughable defense, because embedded in this history is the explanation for why you don't need $9 billion in cash. 1991 was a pretty severe recession, and during that recession, did Chrysler burn through some cash? Yes. It was a 2-year recession, and they burned through about $500 million in cash. Let's do an algebra problem. If the last recession lasted 2 years and you burned through $500 million in cash, how long will the next recession have to be for you to need $8.5 billion? The answer is about 34 years. So basically you're preparing for the next great depression. This is like a guy who goes into his backyard and starts, building an ark every time it rains, saying, this is the big one, I've got to get ready. I know you got to be a prudent manager, but you can't run the company for a catastrophic risk. So that defense very quickly fell apart, because people said you need cash, but you don't need $8.5 billion. So you know what the second defense was? The Chrysler's second defense was? We need the cash in case we need to do a big acquisition. Does this make you feel a lot better as a Chrysler shareholder? The history of acquisitions around the world is when you do big acquisitions and you're the acquiring company, you're more likely to be the loser than the winner in this game, because you tend to overpay. So that defense fell apart as well. The end of the story was that Chrysler had to end up returning almost 2/3 of the cash to its stockholders. It eventually got taken over by Daimler, and then it became, so the rest is in a sense history. But it shows you that company. So why do you think Chrysler got into trouble for holding $8.5 billion in cash? And Google doesn't get into trouble for $100 billion in cash. One is the business you're in, right? In the automobile business, it's not even about you. It's about the entire business. This is one of the 10 worst businesses in the world to be in. You're in it. And if you have a lot of cash and you say, I might need the cash, my reaction is, no, I don't think you do. So the first is the business you're in. The second is your history as a company. Google has earned the right to accumulate cash by doing what? As a Google shareholder, what do you have to complain about? Your stock is up 100% over the last 5 years. You might not like the fact that it's a semi-dictatorship with Brin and Page as the dictators. But the reality is we all like benign dictatorships. We complain about it, but we can get a 20% return and say, I can live with a dictator. The fact that some companies get into trouble is just a reflection of what business they're in their history. And it doesn't look fair, but as stockholder, you have to think like a stockholder. This is your cash. You're leaving it in the company. You're going to do that only if you believe that that cash is going to be deployed well. And if you don't have that trust, you have every right to demand your cash back. And nobody can call you greedy just for doing that. It is your cash. Yes? Not anymore. Remember, after the 2017 tax law, there is pre-2018, this was an issue. Remember we talked about in the context of tax, did we talk about this? Where as a U.S. company pre-2018, the U.S. had one of the most perverse tax codes in the world. And here's what. If you're a U.S. company and you earned income overseas, you had to pay taxes on that overseas income at the overseas tax rate. Let's say you made income in Hong Kong. You paid a 15% tax rate. But with the U.S. tax law as it existed pre-2018, you were also required to pay the extra, remember the U.S. tax rate was 40% then at the corporate level. You had to pay the extra 25%, but only when the cash was returned to the U.S. Congress writes the weirdest laws and expects, it creates these laws with horrible outcomes and then gets surprised by the outcomes. So you're a company, and I tell you, if you make money overseas, we'll tax you, but only when you bring it back to the U.S. What are you going to do? You're going to leave it outside the U.S. Hence was born the phenomenon, what was called trapped cash. Seeing how much cash could have been trapped? At the end of 2017, $2 trillion in U.S. corporate cash was held as trapped cash. Apple alone, $150 billion of the $250 billion cash balance was in it. And here's what it trapped you on. You could not bring the cash back to the U.S. You could not invest in the U.S. You could not use it for dividends or buybacks, but you could invest it anywhere else in the world. Talk about perverse consequences. You said U.S. companies, you invest anywhere else in the world, you're okay. But if you come and bring it back to the U.S., we're going to tax you. So even if you disagree with the Tax Reform Act at the end of 2017, this was one good thing that came out of it. Because it said, this makes no sense. You're a multinational, you make income in other parts of the world. We're going to join. There are only 6 countries in the world that have the U.S. system of taxing everybody, or what used to be the U.S. system. You don't want to know what the other 5 countries are because this is not the company you want to keep. Some strange group. The rest of the world adopts what's called a regional tax model. So if you're a UK company, you make income in Hong Kong, you're taxed at the Hong Kong tax rate, but you don't tax the extra taxes. In fact, pre-2018, you had this phenomenon called inversion, where a U.S. company would buy a UK company. Pfizer tried to do this with Allergan. And after the acquisition, you'd effectively take on the name and the location of the target company. So Pfizer would buy Allergan and become a UK company. So why would they want to do that? Because the minute they did that, their trapped cash became untrapped. So pre-2018, that was an issue. You could not get to the cash. And as stockholders, you actually wanted the cash to stay trapped and leave it, because if you brought it back, the amount of taxes you had to pay was so monumental. You said, no, why would I want the cash? I'm still getting the cash as part of my stock price. So pre-2018, this was a factor in whether the cash could have been returned. Thank God that is no longer an issue, because it was an artificial way in which companies were trapped into holding cash that they did not need. Yeah.
What's your opinion on the Jamie Dimon fortress balance sheet concept?
And what would be the consequences for dividends then from that? I mean, let's focus on the dividend part of it. So, no.
Normally said less would be paid out in cash, but I assume banks' dividends would stayed relatively stable over a long period?
Yeah, I think in a sense, there is an argument that if you're in multiple businesses, you want to create a balance sheet that protects all of your businesses, right? The only problem is some of your businesses then are going to be overcapitalized. It's not an efficient way of, let me put it this way. If you had multiple businesses, each one carried its own capital, you'd be better off because you could take the riskiest businesses, make them carry more capital. So by trying to create one consolidated balance sheet and create enough capital to cover all of your activities, you almost by definition have to hold a lot more capital than you would if you had allowed for individual businesses. So I think from the perspective of safety, it makes sense, but from the perspective of delivering the highest returns on the capital invested, it sounds inefficient to me. So maybe they can find a compromise that will allow them to capture both factors. But it's a safety-driven concern rather than, hey, where can I get the biggest returns on my equity? Okay? And from a dividend perspective, it's going to mean you get a consolidated dividend, which is probably going to be less than what you could have got again from individual businesses, because I have to make sure I retain enough of it to cover my riskier businesses. So, you take it for whatever it is. If you're investing in JP Morgan, you are getting the entire company, and you want to make sure the entire company is protected. From that perspective, it makes sense. But if you could break the company up, I would, because I think everybody's going to be better off from that breakup. So I'm going to ask you to do your free cash flows to equity. You've done the optimal capital structure, right? Let's act like you have. And once you've done the optimal capital structure, you ask the question, do I have too much debt? To finish that part and get to the dividend policy. It's actually the cleanest part of corporate finance because it's all in that statement of cash flows. So you're going to Capital IQ, you can download 10 years of statement of cash flows. In 15 minutes, you can have free cash flows equity every year. You have the dividends and buybacks in that same statement of cash flows compared to what actually gets returned. You're on your way. Because the last part of the process, you're going to ask the question, do I trust my company with the cash? So let me go through the framework for assessing dividend policy, because this will allow you to make that judgment. So you get your free cash flows equity from the statement of cash flows. You get the dividends and buybacks from the statement of cash flows. You compare the two. One of three things is going to be true. Either your company returns exactly what it should, in which case leave it alone. Say this company is doing the right thing. But let's take the two other scenarios. Your company could be holding back cash, like Google is, or returning more than its free cash flow equity in the form of dividends and buybacks. So let's take the easiest scenario again. A company pays out too little, either because it's paying no dividends and has no buybacks and has a positive free cash flow equity, or it's a positive free cash flow equity and it's returning less than that amount. If your company is paying out too little in dividends, it's accumulating cash. So take a look at your cash balance, because that will tell you whether your calculations are in fact right. Because if your free cash flow equity is much higher than your dividend, your cash balance today should reflect that cash accumulation. If you have a big cash balance, you're holding back cash. The question you're going to ask is, do I trust the managers in this company with my cash? Again, use the word "my" because it makes it clear that it's stockholder cash that's being held by companies. And to make that assessment, don't just look at what managers say. Look at their history. Are they taking good projects? That excess return that you computed at the end of section 5 of your project, we compared the return on capital to cost of capital. Look at the Jensen's Alpha. How well has my stock done? And if your stock has done well and they're picking good projects, then give them the benefit of the doubt. Look, I trust you, and if I trust you, I'm going to allow you to hold the cash. But for the moment, because you very quickly could lose my trust by doing what? By doing something stupid like a big acquisition. But for the moment, you have my trust, I'll let you hold the cash. But if you have a history of taking bad projects and delivering terrible returns for me and you're accumulating cash, don't be surprised to see me put up a fight. Say, I want my cash back. And as I said, there's nothing greedy about this. This is your cash. You want the cash back, not because you want to buy a Cadillac or a Bentley, but because you want to invest it somewhere else in a company you can trust. You're going to push to see cash return. This is an activist investor's dream company to target. The Carl Icahns, the Bill Ackmans obviously target these companies because they say, look, nobody trusts these guys with the cash, so we're going to push them to return the cash. We're going to get lots of company because everybody's going to jump on the bandwagon because now they have somebody advocating that more cash be returned. And this is happening across consumer product companies now because their best days for many of them are behind them. They have a history of accumulating cash, and people have lost trust in them. On the other side of the equation, if you have a company that's, yeah, go ahead.
When you look at ROE compared to cost of equity and try to determine what is good or trustworthy, you're doing that within an industry or a sector. Comparing against
First, you're comparing, the ROE has to be higher than the cost of equity, right? So that comparison, you don't need to bring any peer group in. So if your ROE is less than the cost of equity, I don't even care what the rest of the sector is doing. You should be, I don't trust you. You're in a bad business. If your ROE is higher than the cost of equity, you're starting from a position of strength, right? If it's not as high as the rest of the peer group, that's not a dividend problem, that's an investment problem. I can go back and say, what? But if you have good projects and you're taking those projects, but they're not as good as the peer group, I can change the way you do investments. That's where the pressure should be. It's not on dividend policy. So my key is, are you making more than you need to on your money? And that becomes the basis for making the judgment of, do I trust you with the cash? If your company is paying out too much to its shareholders in the form of dividends and buybacks, I'm going to ask you again whether you have good projects. You're saying, why do you care? Because if you have good projects, you're earning more than your cost of capital, and you're paying out more than you can afford to, you're doing double damage to yourself. Do you see why? First, you're paying out too much. Second, by paying out that amount, you're probably taking fewer projects, and you shouldn't have lots of good projects. You're actually affecting yourself negatively in two ways. You're taking fewer projects than you should because you're so busy returning the cash. And by paying out so much cash, you're putting yourself deeper into the cash flow hole. So if you have good projects and you're returning more than you can afford to in dividends, I'm going to push you to return less. Even though it might mean a painful dividend cut if you're paying dividends, but if you're buying back stock, which is the way most companies are doing this now, I say, stop doing this. Everybody else in your sector might be buying back stock, but you shouldn't be one of them because you have good projects. And by buying back stock, you're hurting yourself, and it's hurting me as a shareholder. But here's your worst case scenario. You look at your company, it's paying out more than it can afford to in dividends and buybacks. So it's got a dividend problem. Then you look at its projects. They're awful projects. The return on capital is less than the cost of capital. You don't know where to start now, right? Because if you cut dividends, what are you afraid they will do? They'll take the cash and take even more bad projects. This is a company whose dividend problem came from its investment problem. Most companies, when they have a dividend problem, it's a consequence of taking bad investments rather than the other way around. And if you don't fix the investment problem, if all you do is fix the dividend problem, it's going to come back. You have to go back and deal with the roots. So when I say everything is connected in corporate finance, so that's why you have to look at the assessment of investment policy, the capital structure, and the dividend policy together. Because without looking at all three, you really can't tell me whether your company should be increasing the amount returned to stockholders, decreasing the amount, or doing nothing. So on Wednesday, we'll start with a quiz, and after we finish the quiz, I'm going to take each of my companies through this framework. I'm going to take Disney. So the dividends are not covered in the quiz, so you don't have to worry about this, but given that this is what your project is going to involve, if you can bring at least preliminary numbers for your company, as I go through my companies, you can work through yours as well. So I'll see you on Wednesday.
So one of the things I've actually been batting this around for like a little while now. So this is my DCF from valuation, doing the same company in both. One of the challenges with my company is it's essentially crashing and burning. And I've been
Negative revenue growth, declining margins, so how badly is it crashing and burning?
like really bad. Like its bond rating is deteriorating entirely. It has negative free cash flow, has a massive acquisition, and it's 98% debt. It's pretty dumb.
So it's really nice. Today we're going to talk about equity as an option. Who you do? What's the company you doing?
Community health system. Yeah.
So you're buying an
lost.
option. So basically, your DCF is going to give you probably a negative value.
Yeah, it has given me a negative value, and that's what I expected. And this is
And
your
how did you
comment
price
here.
it?
Sorry.
How did you price it?
Oh, you mean using multiples? I haven't priced it.
Using EV multiple, you probably get the same kind of result. So whatever EV you get will be less than the debt.
Yeah, so it'll be a negative number. So
So
it's
you
kind
would-
of meaningless.
Well, you're not going to buy this company as
Yeah,
a going
yeah, yeah,
concern.
yeah.
And you're not buying it because it looks cheap relative to other companies. You're buying it for the same reasons you buy deep out of the money option.
Because of
You hope that something good will happen to the value that will cause it to rise so that your tiny slice of equity is going to become a bigger slice. Because remember, if your 2% becomes 8%,
yeah,
that's a 400% return,
Yeah.
right? So you're buying for the same reasons you buy an option. So today when we talk about equity as an option, you're going to take the DCF values as your starting point for that option. Your value for your operating assets is going to become your S in your model.
Okay.
The face value of your debt is going to become your K. So right now S is less than K. You're
Yeah,
out of
yeah,
the
yeah.
money.
Yeah.
But you're going to introduce
So
a
you
variance.
just want a ton of variance. That's what you're saying.
Exactly. You want, that's your only way. Your
That this
equity,
makes sense.
This makes any sense because the variance is zero. You're dead, right?
Yeah, it's.
So you want a ton of variance, and you
Yeah.
want your debt to be long-term enough that you get the time for the variance to play out. So the option life is going to be the average
You
maturity
need
of your debt.
something very long.
Or at least the average maturity of the debt has to be long-term. So
Okay.
two things will drive the equity value. One is the variance in the business itself, so the uncertainty about
Yeah,
the
yeah.
value. The second will be is the debt. So if your debt approaches zero maturity, your value of the option goes away. So two
Yeah.
things will drive the value of the option away. One is that the variance goes to zero, which is
Yeah, yeah.
unlikely. The second is the time on the debt. The
Goes to
average
zero,
life of the
which
debt
is more
goes to zero,
likely.
which is more likely, in which
Yeah.
case the company's dead. But so the optionality will come from those two forces coming into play,
Yeah.
which
that
means
makes a lot
that
of
the
sense.
option might still have positive value.
I
because-
don't think it will, but I can see that it
But the
could.
stock is trading, right?
Yeah, it is.
So people are buying the option,
people-
right?
people are buying
Buying
it,
the
yeah,
option. They're not
yeah.
buying it on cash flows. They're not buying
Yeah.
it for dividends. They're not buying it on a pricing
Yeah.
basis. They're buying it as an out-of-the-money option.
Yeah.
So I
No, that
wouldn't
makes
be.
sense.
It's amazing how much options can have, how little can give you value in an option, right?
Yeah.
If you have 2 years left in terms of average maturity, even an out-of-the-money option will have some equity
some
value.
value.
Yeah, so basically,
That's
that's what's going to happen is your DCF value, your equity is going to be worth nothing. Your pricing, your equity is going to be worth nothing. Your option, your equity is going to be worth something. The interesting result will be is that something is higher than the stock price.
Yeah.
Because then you got to ask yourself, am I willing to buy this option, right? Because that's what you buy.
Yeah, that makes sense. So two follow-up questions
Yeah.
on that. One thing with this,
How are you doing this for corporate finance? Or how
I'm
are
not.
you
This is for
Okay.
valuation.
Yeah, I thought you
Yeah.
said you're using the same company
I
for
am.
both.
I'm using it for both. I'm using. So this is my DCF valuation.
But how are you doing this company for corporate finance? Because if you have negative operating income, isn't your optimal debt ratio zero and your dividend policy? I mean, everything will get zeroed.
it's, the optimal debt ratio that I got for it was like 40%.
So they must have operating income. Because without operating income, the optimal debt ratio can't be 40%.
I'll have to look at it. Maybe I filled it out wrong.